Hi everyone, welcome back to another episode of our YouTube channel. Now at new purchase and refinancing, clients can set the tenure that they want for their loan. And most have asked me what's the maximum they can go and what should they set. So this episode is going to explain a little bit about what's the maximum loan tenure you can get, and at the same time, how many years should you choose for your loan. Now a little fun fact. Now for the longest time, I've always wondered why banks spelled tenure as Tenor. So I've decided to investigate this and hope that with this definition, you understand also why there are two kinds of spelling available. Now whilst Tenor can mean a singing voice between baritone and alto or countertenor, the highest of the ordinary adult male range, the financial term as a noun also means that the time that must elapse before a bill of exchange or promissory note becomes due for payment. So there you go. Tenor is not a wrong spelling like I always thought it was. What is the maximum allowable tenure? At the point of purchase, you can choose 25 or 30 respectively for HDB and private property. If your loan size is the standard 75%, if you drop your loan amount below that to 55%, then you can extend that by a 5-year each. And refinancing is different. The formula used would be 29 years minus the number of years of ownership for HDB and 34 minus years of ownership for private property. You can choose anything between your existing loan tenure to the maximum allowable. Let's answer the most important question. How much interest do I actually pay for the entire loan tenure? So this table gives you a breakdown of how much you pay on the monthly level over 2 years, over 3 years, and the entire loan tenure if you were to select a loan size of $750,000 over loan tenures of 10, 20, or 30 years. Now I apologize that the table at the bottom blocks off a little of the number, but it's actually 78,121. So what happens is, if you would choose a loan tenure of 30 years, you pay $2,772 per month. For 20 years, $3,794 per month, and 10 years, $6,901. Now, over a 2-year period, this is the total amount of interest you pay for these 3 loan tenures, and over a 3-year period, and then finally the last row shows the total amount of interest that you have paid over this number of years. Now, if we look at these numbers, it seems like a no-brainer that you should choose a 10-year loan tenure for as short as possible because you only pay $78,121. However, it means that your monthly loan installment will be $6,901, and that may not be practical for most people. So it's a balance of your cash flow on a monthly basis, how much you can afford, versus how much total interest you would like to pay over the loan tenure. Let's pick the more plausible scenarios between a 20-year loan tenure and a 30-year loan tenure. Now, if for 30 years, your total loan interest would be $247,972, the total loan interest over 20 years would be $160,590. The respective monthly installment will be $2,772 and $3,794. What do you decide? So instead of deciding on how much you want to save versus how much you can afford, perhaps I could give you another counter proposal. Now, if you were to save $1,000 per month over this 30-year period, because you have saved the extra from cash flow at a very nominal 2.5%, which is quite possible, you will see that over the principal of 30 years, you're actually saving $360,000. And a compounded interest of 2.5% per annum over each month over a 30-year period will bring your total return to $536,482. Now, between the 30-year tenure and 20-year tenure, the loan interest that you're saving is about $80,000. But if you have the extra $1,000 and you use that cash flow to just save and invest, you actually have a much greater return over the 30-year period. Now, the conclusion here is that investment is always better because your money is being leveraged. The loan that you're borrowing for your home loan is on a reducing balance, but your investment after savings is on a compounded basis. So how to go about doing this? I've had a video on UOB One account where as you save more money, you get a high yield interest. And that's one video. Another video that we have made talks about how you can save to the maximum of $75,000 on a UOB One account, then withdraw $50,000 at one time for some kind of fixed income product to further grow your savings. Now, these two coupled together will actually make your interest earned more than 2.5% per annum. But for a very practical and realistic number we put here at 2.5 over 30 years, you are already getting back $536,482. Now, for more details and breakdown on why we counter-propose a longer loan tenure but using the money to invest, do contact us at this following number and email address so that we can give you a more in-depth discussion on a one-to-one basis on why we propose this. Till next time, see you.